Welcome to Talk Tickers. Today we are breaking down Third Bancorp's latest earnings for Q4 2025. Now, on the surface, it looked like a really solid quarter. But the real story here, the one you need to pay attention to, isn't just about the numbers. It's about the massive, game-changing acquisition of Comerica. So let's dig in and see what this all means for the bank's future.
All right, here's how we're going to tackle this. First, we'll hit the headline results, the big beat. Then, we're going to pop the hood and look at the core engine that's actually driving performance. After that, we'll walk through the 2026 roadmap that management laid out. Then, of course, we've got to talk about the main event, that transformative Comerica merger. And we'll wrap it all up with our final take on what to expect next.
So let's start with the results. On paper, Fifth Third knocked it out of the park with a strong earnings beat. Pretty much strength across the board. But the market's reaction was kinda meh. And that brings up a really important question. Was all this good news already baked into the stock price?
The number that really grabbed everyone's attention was the adjusted earnings per share, $1.08. That's a clean 8-cent beat over what Wall Street was expecting, which, always sets a positive tone right out of the gate.
Revenue also squeaked past expectations, coming in at $2.35 billion. Now, it's not a huge beat, but it signals that the top line is stable. And in an economy like this, stability is exactly what investors are looking for.
Okay, now this is a big one. A record $1.5 billion in net interest income, or NII. That's just the profit a bank makes between the interest it earns from loans and what it has to pay out for deposits. Hitting a record here, it just shows they are managing that spread, that core banking function, absolutely masterfully.
So if the numbers were so good, why the quiet reaction from the market on earnings day? Well, this chart tells the whole story. In the 3 months leading up to this report, the stock was up almost 22%. It was absolutely crushing the broader financial sector. So a lot of this good news was just, well, it was already priced.
Okay, so headline numbers are one thing. Let's dive a little deeper into that core engine. Because when you look past the big figures, the underlying business showed some really impressive strength. Management wasn't just chasing growth for growth's sake, they were delivering profitable growth. And this wasn't just an interest rate story either. Sure, net interest income grew a healthy 6% year over year, but look at the other businesses. Commercial payments, up 8%, and wealth and asset management fees, up a whopping 13%. This shows you they have a really well-diversified revenue engine humming along.
If you listen to the earnings call, CEO Tim Spence hammered home this one theme over and over again: profitable relationship growth. It sounds like corporate speak, but it's really important. It shows a disciplined focus. It's not about just getting bigger, it's about building deeper, more profitable relationships with the right kind of clients.
And here's the proof in the pudding. An adjusted return on tangible common equity, or ROTCE, of over 20%. That is an absolutely elite figure. It's basically a scorecard for how efficiently the bank is using shareholder money to make profits. And a number this high, it just screams exceptional discipline.
All right, enough about the past, let's look forward. Management didn't just give us some vague commentary. They laid out a really detailed, quantified roadmap for 2026. And to me, that signals a very high degree of confidence in what's to come.
They're guiding for continued strength pretty much everywhere you look. They're planning to maintain that elite ROCTE. They see loan growth in the mid to high single digits, and they're keeping their net interest margin really robust. What they're basically telling the market is, hey, that strong performance you just saw, that wasn't a fluke. That's our new baseline.
But, and this is the crucial point, there's a big assumption here. Their entire outlook is built on a very specific forecast for interest rates, 2 quarter-point cuts from the Fed. If the economy zigzags and the Fed does something different, this whole guidance framework could be out the window. It's really the key risk you've got to watch.
All right, let's get to the main event, the integration of Comerica. You have to understand, this isn't just another deal. This is a company-defining merger. It completely reshapes Fifth Third's footprint, its scale, everything. And if you had any doubt about the conviction behind this deal, just look at these numbers. I mean, 99.7%, 97%. That is overwhelming shareholder approval on both sides. This quote from the CEO just shows that investors are completely bought in on the strategy.
Management gave us a very clear 4-part playbook for how they're going to unlock value here. First, scale up Comerica's commercial business. Second, deepen what they call wallet share, which is just a fancy way of saying get more business from the clients you already have. Third, and this is big, aggressively expand in the booming Texas market. And finally, combine their tech and life sciences banking expertise. It's ambitious, for sure, but it's a very logical plan.
And this right here is a massive update. Management isn't just on track with their plan, they are accelerating it. They now expect to hit their 2027 performance goals by the end of this year, 2026. I mean, that is a huge signal of confidence in their ability to execute.
Okay, so what does all of this mean for the stock going forward? Let's pull everything together into our final analysis and give you our take.
So it really boils down to two competing stories, right? You have the bull case, which is pretty simple. They execute this Comerica integration flawlessly, they get those synergies ahead of schedule, and they ride this huge growth wave in markets like Texas. Then there's the bear case. Big mergers are tough. What if the integration gets messy? Or what if corporate clients get nervous about the economy and just stop borrowing? One analyst called it chronic postponement syndrome. If that happens, the whole growth story could stall out.
So here it is, the next call. The number one thing to watch next quarter is any update on those merger integration milestones. That's where the story is now. The stock price from here on out, it's going to be driven by execution, not by macro noise. And frankly, given their accelerated timeline and their proven track record, we think the risk-reward looks pretty favorable. Our rating is outperform.
As always, please remember this analysis is for informational purposes only. It is not financial advice.